morning, everyone. Welcome to the Stock Market Morning Prep video for Monday, April 28th. Well, we had risk off across the board on Friday. Dow Jones down 140, NASDAQ down 72, S&P down 15, and Russell down 21. So we're having, the markets have no memory from day to day. We're popping up for a couple days. We're selling off. And it just seems to me, like I mentioned in the previous videos, that the markets are looking to carve a top. I'm not going to call a top just yet, because we're going to need some more evidence that the markets are indeed starting to break down and headed lower. We are up in the early morning session here in the ES, up about 5.5 handles. Really not much of anything to write home about, but we are coming into the seasonal weakness now. Remember, equities are actually getting that rotation that's coming out of risk. You know, we have the Russell lower, we have transports, which are leaders, starting to break down now from a nice move up we had for several days. So that's actually giving us clues. We also have money rolling into utilities, consumer staples, energy, and that's really the key driver. Money coming out of consumer discretionary. All of the high beta names, LinkedIn, Baidu, Google, you name it, are really have been taken on the chin the last 2 weeks. So when the leaders are starting to break down, that is your cue to say, okay, we have rotation coming out. Now, money's rotating in different sectors. You know, that's one thing, money staying in the market. But the real caveat here is going to be bonds, and I want to get right into it. Now, if you could see here, the 30-year, if we were basically looking like right up in this area here, how we kind of had this bull flag, we chopped around, and then we starting to break out of this trend line. But if you really push it in, bring this back in again, you'll see this has a really big inverted head and shoulders pattern, and it has now broken out of the neckline. And if you remember a few times back, we said, you know, equities were running higher when we had that holiday reversal week, and really bonds didn't go anywhere. Yeah, it sold off a couple days, but bonds really did not go anywhere. That's a big sign saying that money's rotating out into bonds. Now, if money does come out of equities into bonds, that's where you're going to have that decent sell-off. And I am looking for a decent correction, anywhere from 8 to 10%, at least to get started. We haven't had an 8 to 10% correction, I think, in about 3 years. And it's well overdue. I think it's healthy for the markets. We are in a seasonal time where markets are weak, where strength in the bonds, seasonality, is from May, I believe, until October. So bonds have all of the everything lined up for it, if you will, to move higher. So watch the bonds here. I think bonds are going to be a decent trade moving forward. So let's go into some other charts here. Spiders, you can see this uptrend line is still holding. We are above the 50 and the 20. So that's why I say that, you know, we need some more, we need additional movement lower, a breakdown lower, because as you can see here, we're up 5-6 days. We're down 2, we're up 5, now we're down 2. There's a market revert and run back up again. That's the problem that we're having. We really don't have a trend. Even though the longer term picture, the markets are up, and that's true, but on the daily chart, the markets are violently moving and reverting back one way or the other. If the market opens up, it sells off, takes everybody out, moves back up again. So that's when you have the extreme volatility. That's not what we want as traders. We want to be able to identify the trend and ride that trend for the day, and even for days and weeks. But it's not happening now. We're getting this crazy volatility, markets moving lower, but we do have willing sellers at these levels. So that's what you have to be careful here. Okay, so, you know, after you buying things and selling stocks, it could be it's a little difficult at the moment. However, I do see that the markets are probably looking to break down. We'll see what happens today. Maybe Monday we get a little bit of a pop back up, and then Tuesday we start to sell off. We do have our big non-farm payrolls that come out this Friday, so that's going to be definitely a news-driven event, all right, a risk event. So let's take a look at the other transports. As you can see, 2 days right off the bat, transport sold off pretty hard here after making new highs. And I mentioned this to you, and I showed you on another chart. I said every time the transport's made new high, it sold off. Made new high, sold off. Made new high, high, sold off, and then you can just see back here, made new high, sold off, made new high, sold off, and so on. So repetitive patterns definitely plays a big role here if you could identify this on a chart. Now we're above the 20. So let's see if we start breaking down here. Remember, watch the leaders, the Russell, the transports, and the Qs. Those are our three main leaders. And look what's happening with the Russell. The Russell just can't even get out of its own way. It's already testing the 200-day moving average. Again, not good for the bulls. One of our leaders are breaking down miserably. Okay, and that's where you get the movement in healthcare, a movement in energy, movement in consumer staples, movement in utilities. Okay, even gold is starting to break, starting to move higher, which I like the gold trade. I'm really liking the gold trade because of the dollar. Dollar is starting to break down, and if you were to just take a look at some of the analysis on the dollar index, I could show that to you real quick. You can see the dollar starting to break down here. We have a very large head and shoulders pattern I showed you last week, and we have the big band of support here. It's going to take a little while, but once that breaks down, you're going to see a lot of these commodity stocks start to break up higher. That's why we have a lot of the energy plays moving higher. And gold, for now, even though in the longer-term picture, still in a bear market, technically, I do like it here at these spots for a trade. We just need to look for an entry, though. Okay, remember though, watch the dollar. Whatever the dollar does, that's the opposite of what commodities do. So we have the IWMs here breaking down. So again, another leader. Here's another one of our leaders. Technology starting to break down. We had the SMH, was the semiconductor ETF, breaking down as well. So not good. We're internally starting to move lower. We're starting to break down in our internals, our breadth. We have weak signals of breadth, so that's not good. Even though you have the markets up, six, seven handles, it really is not much. Doesn't tell me much of anything. So we'll see. It'll be an interesting day today to see if risk comes off again, or if we get some follow through to the downside. And again, diamonds, ETF for Dow Jones, holding above the 50. But if we start to break down here and we lose this uptrend line from November of 2012, then we could see some further weakness and at least a test of the 200. I think the markets are at the very least going to test the 200, and if not further. This is really where the first target would be the February lows, February 5th lows on all of the indexes. Here's the SMH, like I mentioned, really starting to break down miserably now. Now made a lower high from this previous high, so not good. And we're below the 20, and we're testing the 50. So, semiconductors are a big part of what we're looking at. Home builders. I showed you the chart of lumber versus the home construction. Lumber is starting to break down here, and that's a big leading indicator for the home builders, okay, and also interest rates as well. So not looking too pretty. Again, I do like the home builders, but it's going you pick your spots for the year. Right now is not the time to be looking to buy the home builders or add in, because we got to get through the seasonal weakness first, and then we can start picking up some of these some of the weaker stocks, weaker sectors like the home builders. Look at the banks. Banks not looking too good either, starting to break down as well. So you have everything looking at lower prices, and then that is something that you need to understand, so you can be ready for what the next move is going to be. Now, OIH, the oil service sector, had a fantastic run. We talked about this. Beautiful, beautiful move higher. What I'm looking at next is if energy is going to continue to get bid up, and if the dollar does sell off. Look at the drillers. Diamond Offshore came out with some good earnings. Noble, Rig, ATW. Those are some of the stocks that have not moved with energy moving higher. So it looks like they might want to play catch up. So I'm going to be looking at that sector for specific buy-ins. We don't want to be looking to be picking a knife, catch a falling knife, like on the high beta names. That's not going to happen. If technology is breaking down, they're all going to break down. Look for some strength in some different sectors, like the drillers, like the oil service sector. I mean, they're way above their 20-day. So it would, for me, I'm going to look for them to pull back. But sectors that haven't moved, like the drillers, would be a great area to start looking. Okay, and again, gold. And here's ATW, just to give you an example. It has not moved yet. This nice little big basing pattern above the 200. You're going to have a nice move into the upside. So ATW I like a lot. Look at Apache. It hasn't really broken out of this base here. We had that little base. We broke out. Good looking chart. Now this one is above the 200, so the APA looks fantastic. I do like that as well. So these are sectors that you can find, and USO pulled back nicely here. So let's see if USO can chop around and base a little bit for a move of higher prices again. Okay, so that's what I'm looking for. That's going to be the play for this week, and then we're going to wait for that non-farm payroll number to come out. Again, if that non-farm payroll number complements further downside, then I think that's going to put the nail in the coffin. I think we should see some lower prices. But remember, let the analysis tell you what to do. Don't assume and say, oh, I think we're going lower or we're going to move higher and I'm going to buy the dip. Don't do that. That's where all of the novice traders do. We want to be professionals and we want to act accordingly based on our analysis, okay? So right now, yes, I do think that the markets are headed lower, but we need more confirmation. That doesn't mean that we can't trade it for the day. I mean, that's the beauty part about the analysis. You can trade it for the day and then build bigger positions as you get your confirmation. So I'm not going to call a top just yet. I want to see some further downside. I want to see key pivotal lows taken out with lower lows and lower highs, and then we can call a top. At the moment, we're just going to take it one day at a time and trade the best setups possible. All right? Hope that helps. Have a great day, and we'll speak to you tomorrow. Take care.